This is Steven's story and tips on trading. Let's talk about some of the delay tactics that brokers, the market makers particularly, will use to protect their interest. Since they're trading on the opposite side of your trade and they're going to win from your losses or lose from your wins, the broker is not necessarily your friend. Now, that's not all brokers, but particularly market makers who trade against you through a dealing desk. I call them delay tactics, but I might just as well call them sabotage tactics, okay, if I dare say that. Delay tactics because they'll either delay the entry of your trade or the exit of your trade through several different methods, okay? You can experience these in a demo account that they'll provide you for free, but they will pay much closer attention to a live account, especially when that live account is doing well. I definitely feel like the broker is flagging your account, because if they're trading on the opposite side of your trade, they're going to lose if you win. So here are several different ways that they might trip up your trade or delay it, if I may say it that way. First, a requote. A requote is requoting a different price because, as the broker will tell you, well, that price is no longer available, so we are going to give you a different price. The price generally is a price that is more to their advantage than yours. It's generally a price that has increased the spread rate, so that you're paying more money to enter that trade. But in any event, it's always working in the favor of the broker, not you. A requote usually will allow the broker time to extend or watch the market extend further in its progression, which means you have less opportunity to make money with that trend. Or it will delay your entry of the trade long enough or increase the spread rate far enough that the broker is going to wind up making a lot more money on it than you do. At least that's the potential. It may also delay your entry into the market sufficiently long that by the time you do get into that trade with the requote that you accept and they also allow you to enter without giving you another follow-up requote, you will sometimes find that you've entered the market right toward the end of the trend. And if you enter toward the end of the trend, you're chasing the trade, sucking the fumes off the tailpipe, and it's going to turn against you just about the time you thought you were going to get in on that trade. Now, then you end up having to cut a loss from your trade, and they make money on both the increased spread rate as well as on your loss when you cut it, because it's going the wrong direction now. Now, that's just one fairly common method that you'll see for brokers. Others, you might see little windows that pop up on your screen that say, please wait. And they might be there for a few seconds, again, while the market is still moving. They might pop up, context is busy, or invalid price, or locked screen, or maybe they put a padlock on your screen that locks up your trades entirely in a very fast-moving market, depending on the broker you're working with. These are all tactics that can delay the entry or the exit of your trade. If you can't close a trade when you want to, when it's in the profit position where you want to bank those pips, if the broker delays it and therefore you can't close it, then the market may recede and you may lose ground on profits you'd already gained. This is another way for the broker to prevent you from winning as much and him losing as much if he's trading the other side of your trade. Any of those tactics are all, in my mind, methods that a broker will use to sabotage your trade. Now, is a broker going to like to hear me saying this? Are they going to admit to these things as being the tactic for that purpose? Probably not. But if you are the broker and you're trading on the opposite side of that trade, and all those things seem to make you better money or prevent you from losing money to the wins of a client, whose favor is that working in? Now, this may sound really scary. If you think, if the broker's going to sabotage my trades, why would I want to trade? Sounds like all the cards are stacked against me in the deck. Well, there is a way to mitigate those risks. I've learned a few of them. Let me just share a couple, okay? First of all, it's who you choose as a broker. Now, on other video clips, I've talked about the market maker, who is the retail broker, and the ECN broker. If you're gravitating toward an ECN broker, they're your friend, because they're not trading against you on the opposite side. They're just making money on spread rates, which is not a conflict of interest. So the ECN broker is very important to find. Some other ways of mitigating those risks, however, would be the trading style. There are certain trading styles that the brokers have a more difficult time delaying, okay, if I may say it that way again. The broker's not going to be able to delay or have as much incentive to delay a trade that is traded very conservatively. But they have great incentive to delay a trade which is being leveraged at a high percentage of the account. A 25% of your account trade could stand to make a lot more profit in one single trade than trading, say, 1 to 5% of your account. So if you're trading lower leverage trades, lower percentage trades, you'll tend to be able to get in and out of trades more effectively. Also, if you learn to forecast the market better so you're entering your trades at a time of the market when it's not moving as fast, but you can see where it's headed, then you can generally get in and out of trades rather easily. The broker will interpret, or the liquidity provider will interpret speed in the market. Now, they can look at a market and figure it's moving faster when you might still think it's moving like a snail. But when they say fast market moving policy or fast market policy determines whether they increase the spread rate or the volatility or delay your entry, it's by their interpretation, remember that, not by yours. If the market moves 20 pips on a 1 minute chart in 1 minute, they could call that a fast moving market. But on a currency pair like the pound yen, that's not very fast at all. So remember, your interpretation of the fast moving market is not the one the brokers can necessarily give to it. They'll decide when they want to interpret a fast moving market and therefore apply greater spread rates, greater delay tactics, and so forth. Use conservative trading entries. Use entries that are at slow points of the market where you can yet see where the market is headed. Or use ECN brokers. You might be able to find a retail market making broker who does not practice as many of those delay tactics as another. That's Tips on Trading. This is Stephen Story.